What if I told you there's a fee most homeowners pay, even though it protects the bank, not you? It can add $150 to $400 every single month. And most people don't even realize when it disappears or how to legally avoid it. Today, we're breaking down PMI, what it is, why it exists, and how smart buyers remove it without breaking any rules. Stay till the end, because one of these methods works even after you already bought the house. PMI stands for Private Mortgage Insurance. Here's the simple truth. If you buy a home with less than 20% down, the bank sees you as higher risk. So they protect themselves. PMI is insurance that pays the lender if you stop making payments. Not you, not your family, the bank. And yes, you pay for it. Usually, it's $100 to $400 per month. It's added quietly to your mortgage payment. And many people assume it's permanent. It's not. But lenders don't rush to tell you that. From the lender's point of view, PMI makes sense. If you only put 5 or 10% down, you have less skin in the game. So PMI is a risk buffer. But here's the important part. PMI is not a penalty. It's not interest. And it's not locked in forever. It's a condition. And conditions can be changed. The biggest lie homeowners believe is this: PMI lasts for the life of the loan. That is wrong. By law, PMI must automatically drop when your loan reaches 78% loan to value based on the original purchase price. And you can request removal at 80%. Most people never do. Why? Because they don't track their loan balance. They don't know appreciation counts. And banks don't remind you. Silence saves lenders billions. The cleanest method is obvious. Put 20% down and avoid PMI entirely. But for most buyers, especially first-time buyers, that's unrealistic. So here's what matters. You don't need to start at 20%. You just need to get there strategically. This is the method most people miss. Let's say you bought a home at $400,000. You put 10% down. Your PMI is $250 a month. 2 years later, the market moves. Your home is now worth $500,000. Suddenly, your loan-to-value drops below 80%. At that point, you can request a new appraisal. You prove increased equity. And you ask the lender to remove PMI. Legally, cleanly, permanently. One phone call can save thousands per year. This one sounds sneaky, but it's real. Some lenders offer lender-paid PMI. You don't see a monthly PMI line item. Instead, the lender slightly increases your interest rate and covers PMI themselves. This works well if you plan to refinance later or sell within a few years. It's not always cheaper long-term, but it can improve cash flow today. The key is knowing it exists and negotiating it up front. This one is more advanced but powerful. A piggyback loan splits your mortgage into two parts. An 80% first mortgage, a 10% second mortgage, and a 10% down payment. Because the first loan is at 80%, there's no PMI. Yes, the second loan has interest, but in many cases, it's still cheaper than PMI. This works best for strong credit profiles, buyers with stable income, and short to mid-term homeowners. It's not for everyone, but it's extremely effective when structured right. If you already own a home, listen carefully. Here's what to do. First, check your current loan balance. Second, estimate your home's current value. Third, calculate your loan to value. If you're under 80%, call your lender. Ask about PMI removal. And request appraisal requirements in writing. Do not assume. Do not wait for automation. Be proactive. This is one of the highest return phone calls you'll ever make. PMI isn't evil, but paying it longer than necessary is expensive ignorance. Smart homeowners don't just focus on interest rates and monthly payments. They focus on when fees disappear. If this video saved you money, or will soon, hit like, subscribe, and share it with someone buying a home right now. Because avoiding PMI legally isn't about loopholes. It's about knowing the rules better than the system expects you to.